attention when I'm going over the slides. And then we will do, obviously, the practice problems. So basically, I have two practice problems that I should finish. One is from this textbook, another is from the older version of the textbook. Because that has a little bit complicated, the older problem. It has a deficit capital balance. So we'll try to practice both of them. So let's focus on the slides first. Okay, I'll go a bit fast, but if you have any question, please raise your hand, because the concepts are really important. It's only one concept, liquidation, but multiple steps. So here, all partners are deciding to terminate the business and liquidate the business. So what will happen? If you need to do this type of liquidation, so just try to imagine. First, you have to sell all of your assets, non-cash assets. Like you have a land, building, equipment, whatever the non-cash assets, sell them first. Convert them into cash. So when you are selling those assets, remember you will have a book value and you will have a selling price. And you have to compare when you are selling the assets, whether you are making a gain or loss. Right. If you sell an asset less than its book value, then of course you will make a loss. If you sell an asset at a higher price than their book value, you will have a gain. So first step, we have to sell all non-cash assets. We are converting all non-cash assets, and we have to check if we are making any gain or loss. If we make any gain or loss, we will allocate the gain or loss using the capital balances. Theoretically, we credit gain, we debit loss, but we will not use the account which is called gain on sale of land. No, we will just use the capital balances to adjust the gain loss. Now, when you liquidate the partnership business, you have to pay all of your liabilities. This is simple. Pay liabilities. So remove liabilities, pay cash. Now, you may have some liquidation related expense. You may need to hire a valuator or an investment bankers or someone else. You may need to pay some legal fees. These liquidation expense you have to pay. Definitely cash will be gone. We'll credit cash, but we cannot debit the expense. Instead of debiting expense, we will be using the capital balances. We will do all of our adjustments using the capital account, because we already closed our income statement. All revenues, expense type of accounts are closed. We took the net income to income summary, we adjusted it. We just have only balance sheet item. So don't create any revenues, expense, gain, loss item. Rather, use the capital balance. So after doing all these steps, if you have the cash, any cash remaining, we will distribute it as per the capital balances. This last distribution will be based on the capital balances, not based on the PL ratio. Basically, whatever distribution we did so far, we did the PL ratio, but remember the last distribution will be based on the capital balances. Whatever capital balances they have, you will see after doing all adjustments, that's the cash you have. So we're going to distribute based on the capital balances. Now let's see one example. This is nothing, this is just a summary. First, try to imagine the state. First, sell non-cash assets. If you have any gain or loss, do the adjustment. Use the capital account. Pay your liability. Pay your expenses, liquidation expense, usually like legal fees, investment banker fees. Remember, when you are paying the expense, don't debit expense account. Rather, we will use the capital balance. And then, finally, after doing all these things, whatever the cash remains, you will distribute it based on the ending capital balance. And finally, we'll close the books. Now we'll see one example. This is the balance sheet. Remember, they closed their revenues, expenses. They closed against net income, against the retained earnings. So everything here, not retained earning, actually capital balances, capital balances. We don't call retained earning or stockholders' equity. Everything we call capital balances. So what we just have? We just have a balance sheet. So now we will liquidate it based on this balance sheet. First, step number one, you have to convert convert non-cash assets into cash. Non-cash assets. What are the non-cash assets? See here. This is the balance sheet just before starting the liquidation. Two partners, Morgan Houseman. PL ratio 60-40. Now here, if you look at that, their total assets is 120. Cash is 45. So these rest are non-cash. Account receivables, inventory, land building equipment. These are non-cash assets, total. Now we will convert it into cash. We will try to sell them. For account receivable, we will try to collect them. Right. So let's do the steps. First, inventory. They sold the inventory for $15,000. Everyone please pay your attention. How much was the inventory? Look at the board or your computer. How much was the inventory value? Inventory $22,000. They sold it for how much? 15. So are they making a gain or loss? Loss. $22,000 inventory. They sold it for 15. What's the total amount of loss? When they sold the inventory, what's the loss? 7,000. Now you have to record it. Remember, you are selling inventory. No longer you will have any inventory no cash. So you have to close the inventory, remove the inventory. You sold it for some cash. You have to record the cash. You are making a loss. You have to show the loss. We will not debit loss. Rather, we're going to use the capital accounts for loss. So let's see the journal entry. You sold the inventory for $15,000. We received cash, $15,000. Inventory book value was $22,000. We need to remove inventory account, make it 0. We need to close it out. So it was a debit balance, we credited it. Now the loss is 7,000. We are not calling it loss on sale of inventory. Rather, we will show it using the capital balances. Of course, it's a loss. It will reduce our capital. It will have a negative impact on our capital. So let's allocate this loss. Two people here, Morgan will bear 60% of this loss, $7,000, 60%, which is $4,200. Houseman will bear 40% of the loss, $2,800. So this is a loss. Loss, of course, will have a negative impact or reduce their capital. So we debited their capital. Instead of debiting loss, we are debiting their capital. Is this journal entry fine? Alright, different step. You receive cash, you debited cash. You remove the asset, you credited inventory. You have a loss. Loss is usually debit. We are not debiting loss. Rather, we are debiting the capital. We distributed the loss between the two parts. Clear? Now, second item. Let's look here. What is the account receivable? Everyone, take it. What is the account receivable amount? Tell me, please, quick. 12,000. Now, what they did, they were able to collect $9,000. Well, usually account receivables converting to loss. Cash means we are collecting the receivables. But they are able to collect $9,000, so they have a loss on those account receivables. How much is the loss? They didn't collect it. They were not able to collect it. 3,000. So again, we will use the capital accounts to record it. Cash, they received cash $9,000. We need to remove accounts receivable $12,000. This $3,000 we're going to distribute between these two persons, and we will debit the capital accounts because loss will always have a negative impact or reduce our capital account. Right. Last non-cash asset, land building equipment. What's the amount here? What's the amount here? Tell me. 41,000. Now when we sold it for how much? Look at this slide. Noah, we sold it for 29,000. The book value was 41. You sold it for 21. Are you making a gain or a loss? It was 41,000. Yeah, you are selling it at a lower price. You are making a loss, $12,000 loss. Again, we will debit the loss using the capital accounts. You received cash when you sold all these fixed assets, $29,000. You need to remove all these assets. So we credited that. And loss, we're going to use the capital accounts. And we distributed the loss. After this, we just convert all of our non-cash assets into cash. Jim? 32, right? You have to pay it. There is no excuse. When you pay a liability, you have to close liabilities. So liabilities will be debited or credited. If you need to close or remove liability, liability itself is a credit number. You have to debit it. You are paying liabilities. Cash is gone. So what should be the journal entries? You have to debit liabilities. You are removing or closing liabilities. You are paying cash. This is the journal entry for recording the payment of liabilities. And remember here, capital accounts are not affected when you pay the liability. Because when I will ask you the journal entry, some of you will write down some capital accounts. Well, we are using capital accounts to do the adjustments for gain or loss and one liquidation expense. But this is only exception. This is the liability payment. No capital account is here. So when we're going to prepare the schedule, I'll show you in a minute the capital schedule, liability payment will not be there. Now next item is the liquidation expense. So if you need to pay the liquidation expense, of course cash is gone. Cash is gone. You see cash is credited. Liquidation expense is $3,000, but I mentioned we closed all of our expenses, so we don't need to debit liquidation expense. Rather, we will be using the capital account. So debit capital account. Right. So these are the steps. Now, if you do all adjustments for these all journal entries and do little t accounts, we don't have time, so I cannot show you the details, but you can see after doing this will be the impact. So try to imagine, they had this balance sheet. All assets are gone. They sold it out. Account receivables, inventory, PPE, they closed it out. On your asset side, you just have cash. This is the amount at the end of the year, $63,000. On the other hand, you paid your liabilities, you have capital accounts. And for every journal entry, especially when you need to adjust the losses and the payment of your liquidation expenses, you debited capital accounts. That means those losses and liquidation expense reduced your capital. So if I show all these background journal entries impact, at the end you will see on your balance sheet, the asset side you just have cash. This is the cash impact. You collected cash after selling all these. You paid liabilities, you paid liquidation expense, cash are gone here. And on the other hand, the liabilities and capital side, you will have the capital balances, these two. Now the final payment will be based on the capital balance, right? Not the PL ratio. So 63,000, you have this cash, free cash, after doing all the steps. Morgan's capital shows 35,000, Houseman's capital shows 28,000. So Morgan will take 63, Houseman will take 28. Finish. We'll close everything, partnership is gone. Now, things are not that straightforward. When you are doing these adjustments, you may see some of the capitals might be a negative now. That means we call it a deficit partner. What will happen? Right. So this is the last entry. We are paying cash. We are closing capital. But I'm telling you another scenario. What if we see we have some deficit partner? So this is another example. We did all these steps. We sold all non-cash assets. We paid liabilities. We paid liquidation expenses. After doing all these background journal entries, this is the scenario. You have cash $20,000. Holland is one guy. He has a negative capital, right? Once you do all adjustments because of the loss or because of any other liquidation expense, any of the partner's capital can be negative. So Holland has a negative capital, $6,000. Then Dossier and Ross have these capital, $15,000 and $11,000. So this is the asset side and this is the capital and liability side. Now what will happen? Dossier and Ross will say, well, my capital account is $15,000, I will take $15,000 cash. Ross will say, my capital account is $11,000, I want to get $11,000. So in total, they actually needed $26,000, but they have only $20,000 cash because there is one deficit guy. So theoretically, what will happen? You remember when we discussed partnership, basically the liability is unlimited. Right. So if you have any negative balance, you are personally liable to pay your personal asset. So Holland, this guy needs to pay from his personal account. If he owns a car, he needs to sell his car to cover this deficit. If he owns a house, he is liable. It is obligated to sell his personal property and to cover up his negative balance. That is why it is called that liability is unlimited unless you are defined as a LLP, limited liability partner. So now what happened, this is their PL ratio. So Holland actually brought some cash from his personal account. So cash is debited. Holland's capital, who can tell me? After bringing this $6,000 cash, what is Holland's capital account? Zero. He had a negative capital. Now he brought $6,000. We did the adjustment. We increased the capital by $6,000. But now Holland's capital is zero. What is the cash balance of the business? 26. Previously it was 20. He brought 6,000. Now these two guys will be happy. Now he made it zero. He increased it by 26. Dozier will take 15,000 cash. Ross will take 11,000 cash. This will be the final entry. We need to close their capital. We already have $26,000 cash. We credited cash. Right. Now, what if Holland is personally insolvent? Holland doesn't have any car or house, or even he doesn't have a single penny in his personal bank account. He cannot pay anything. So then, in this type of scenario, what will happen? The solvent partners need to bear the risk. That's another dimension of unlimited liability. So, the solvent partner, who are the solvent partners here? Who are the solvent partners here? We have two solvent partners, right, Priyanka? So these two solvent partners will bear this risk because Holland doesn't have a single penny. He cannot pay anything, right? So what will happen? The solvent partner will cover the $6,000 loss. Now how they will pay it? We need to redefine the ratio. So how we can redefine the ratio? Because one person is gone, so let's go back here. This is the old ratio, right? This was the old ratio. We have three partners, Holland, Dozier, and Ross. Ratio was 40, 40, 20. But now, Holland is gone. These two solvent partners need to cover up this negative amount. So this negative amount means this $6,000 negative. Now how they're going to cover it? This is a negative amount within bracket. So we need to redefine their ratio. So you just learned it, how you can redefine the ratio. We'll make it a fraction, we'll add it. It will be 4 over 6 and 2 over 6. Or if you want to simplify, it will be 2 over 3 or it will be 1 over 3, right? So we can make the fraction simpler. That's what we say. We will redefine the ratio. So this is the negative portion of this deficit guy, Holland. So Dozier will bear 2/3 of it, and Ross will bear 1/3 of it. Is it clear? We'll do a journal entry one problem. Now, here the adjustments will look like this. These two guys, they are bearing $6,000 was the total deficit amount. So Dozier will bear 2/3 of it. So $6,000. 2/3 means how much, Christine? $6,000. 2/3. 4,000. So Dozier will bear the 4,000 amount of this deficit. Ross will bear 2,000. So this is how they are covering Holland's negative amount, and that actually reduced their capital. After doing these adjustments, their latest capital is 11,000 and 9,000. In total, 20,000. That's what the cash they had. So Holland was not able to bring any cash. So what they did, they readjusted the capital. They made it equal to the cash balance, and they will take based on this capital.